This episode is brought to you by Blockdaemon. You'll be hearing all about them later from me later in the episode, but now, on with the show. All right, everyone, welcome back to another episode of On the Margin, the weekly Roundup edition. Today, I'm joined by special guest, my colleague, Hollywood, Jack Farley. Jack, welcome to the show.
Great to be here, Mike. I always love it.
Yeah. Guys, no Silver Fox for you this week. Mark is on vacation with his family in Europe. I think we'll allow him to miss an episode here or there. So I'm standing here with a very capable Jack. Jack, we've got 30 minutes today, so we're going to do a super lightning round, basically, of everything that's going on in macro and crypto. I think we can get that done in 30 minutes. Tall tale, but I think we're up for it. You've got this slide pulled up here. Are we already in a recession? Walk me through what we're looking at here.
Yeah, so if you had asked me that a week ago, I would have laughed and said, of course not. Of course, it was always possible, but I had looked at like the strong commodity prices. I had looked at economic data, PMIs, personal consumption, expenditure, and concluded that we were kind of a stagflationary environment, but definitely not a recessionary one. The winds of recession may have been on in like early 2023, but we definitely were not definitely, but like we were not likely in one now. But that's changed, and two things have happened. One is just the incredible speed with which commodity prices, oil, natural gas, but in particular like base industrial metals like copper, tin, aluminum, have collapsed. We got this great chart here. I actually think I got it from Alfonso Peccatiello on Twitter that shows the commodities that are down from their 52-week high. So things like nickel and steel are 40, 50% down, which is quite remarkable. Interestingly, on the oil, at least on oil, not natural gas, most of that is the oil stocks are down more than the actual commodity itself, which is interesting. But that's the number one. Correspondingly, inflation break-evens, the sort of market, what the market is pricing in for forward inflation, which is derived from a Treasury inflation-protected security yield, they have fallen sharply as well. So if we go to this chart, you can see that the 5-year inflation break-even rate has fallen from about 3.5% to 2.5%. So basically a 100 basis point fall in a matter of a few months, and falling from 3% to 2.6% in just a few weeks. So that's obviously during a recession, inflation falls. So that's the market. Two things in the market are sort of hinting at maybe something could be going on here. But then what really struck me, honestly, is yesterday's reading from the Atlanta Fed, which is that they're projecting a negative 1% contraction in real GDP for the next quarter. And that is quite extreme. I actually think that's the most negative reading in the history of the Atlanta Fed, with the, of course, huge exception of February, March, and April 2020. When the economy, so basically this is annualized growth. This is annualized quarter-over-quarter annualized growth adjusted for inflation, so real. And if this is true, that would mean that we would have 2 consecutive quarters of real GDP contraction, which is kind of the textbook definition of a recession. So I would say maybe. A week ago, I would have said no way. Now I'm saying maybe.
Yeah. Well, what I would say is, it looks like the Fed, I know you talk a lot about this on forward guidance as well, but the Fed, it's very popular to say right now they can't print wheat, they can't print gasoline. Those are supply side issues. But what they do maybe have some control over is the demand side of the equation. And it looks like they're trying to really crush demand to rein in inflation. One question that I have for you, Jack, is, we've talked a lot kind of on the upswing of inflation, right? And the Fed trying to support asset prices about the wealth effect, right? Which is that as the price of financial asset goes up, people feel wealthier, they spend more, and that drives growth in inflation, right? How does that work in reverse, right? If the Fed crushes demand, if they get the prices of financial assets to fall, do we start seeing the wealth effect start to work in the reverse? And if so, how long does it take for that to become a reality?
I have immense amount of faith in the Fed's ability to control financial markets, in particular interest rates. I think like the Federal Reserve had, I would say, complete control over the front interest rate, not complete control. But I think once you talk about the Federal Reserve's impact on the economy, that's when it gets a lot more dicey. The Federal Reserve did a ton of quantitative easing over the past 14 years. And the growth that we saw in asset markets was very good, but how much actual inflation and growth it made in the real economy is kind of less impressive. So I would say that a lot of this slowdown that we're seeing in the real economy, I would say would have happened anyway, because the inflation is actually deflationary because it destroys demand. That argument, I think, was not accurate for many, many months, but I think it kind of is going into play. So I don't know to what degree I would attribute the slowdown of the reverse wealth effect of people feeling less wealthy, but it certainly played a role.
I mean, walk me through then why you think we're seeing such a drastic decrease in the price of commodities, right? Like these are markets that typically trade independently of what's going on from a monetary standpoint with what's going on in the Fed. So why are we seeing this kind of drastic reduction, both in terms of the commodity prices? And I mean, this is a pretty amazing contraction, right, in terms of GDP. If you've been tracking the Atlanta Fed's projections, right, over the course of the last like 6 or 9 months, we've shown that chart a bunch of times on the margin. I mean, they were initially predicting, an immense amount of growth, right? And it's kind of, as we've gone on through time, it's like, oh, maybe a little less growth, maybe a little less. And now we've seen a 1% contraction. So if it's not, monetary policy and rising interest rates, like what's driving, the decrease in commodity prices? And then I want to get your thoughts on the bond market here. I know you've got some charts.
So the forecast of the Atlanta Fed, it gets more accurate over time. So the forecast of negative 1% real GDP is forecasting what will be released, I believe, on September 29th, which is something like in 90 days from now. And the error function for the GDP, it gets more accurate the closer you get to the date. So like 10 days away, it will do 80 basis points will be the average error, but now it's like close to 2.5 basis points. So that means that like there's a decent chance it will be between either 1.5% of real GDP growth or 3.5% of real GDP contraction, which would obviously be a disaster. I think that's to the point of commodity prices. I think that there's a saying that the cure for high prices is high prices, and when it comes to oil and natural gas and a handful of other commodities, it takes a really long time, to put on a new copper mine. It takes like, many, many years. But in the case of cotton or wheat or soybeans or corn, I mean, it literally, as they say about lumber, like it literally grows on trees, So I think the commodity prices coming down makes a lot of sense.
You're gonna kill at restaurants when you become a dad, Jack, because that was an absolutely A+ dad joke. I hear you. And actually, if you look at the CRB, right, which is this kind of index for industrial use commodities, I mean it kind of goes like this over periods of time, right? There are these spikes and then dips. So yeah, I think cure for high prices is indeed high prices. Walk us through a little bit what, if anything, that you're looking at in the bond market. In previous episodes of On the Margin, we've talked about actually liquidity issues that look like they're rearing their head, right, in treasuries, which is something that we know that the Fed pays a lot of attention to. I would also say that rising mortgage rates, I know that you've got a chart here, again, something that we've talked about on the show in the past, is probably something that we haven't really fully felt the effects of. Well, why don't we start with mortgage rates in general? Because I know you follow this with Eric Bismajian, but he's done a great job of explaining the importance of the housing market in general on the economy. We've seen a pretty rapid increase in the price of or in the rate for a 30-year mortgage, right? It's jumped from like 2.5% or something at the nadir of the pandemic, and now it's really rocketing up, and I think right around 6%. But it doesn't seem like housing prices have really started to respond yet, unless you're looking at different data than me. So you kind of walk us through the significance behind the ballooning mortgage rates, and then when do you expect to see housing respond?
So I would say that mortgage rates is probably one of the most confusing things to me in all of finance right now, because it's like, on the one hand, it's extremely personable. It's like, I'm trying to buy a house and there's a mortgage broker and the bank just, supply and demand sets the loan there. But then also it's the fact that these things are pooled into giant investment trusts called mortgage-backed securities, a lot of which, hundreds of billions of dollars, trillions of dollars, is bought by the Federal Reserve. So there's a mortgage-backed security rates there's a risk-free treasury rate. So it's like comparing it to the 30-year treasury yield, which obviously has gone up a lot for reasons that are not too hard to understand. But then there's a spread between mortgage-backed securities and the treasury yield, and that has widened considerably, so much so that the convexity maven Harley Bassman, guy who invented the MOVE index, has said that he's very, very bullish on mortgages just because that spread is so big. I can't exactly tell you why, though. I was just reading through the Fed's financial stability report, which came out June 17th. We can put a link in the description, and they just said that maybe because they weren't buying as many, or they're not buying any now, and they're actively rolling them off, that played a role. But yeah, I can't tell you exactly, because the rate at which it, I think more than anything, the rate at which mortgage rates have skyrocketed has been quite astounding. Now, to talk about liquidity, I think that the liquidity in general has been like poor after the great financial crisis, and so dealers aren't having as many bonds, including treasuries, on their books. So it's a lot more denominated in futures. So like if I'm a bank and you're a hedge fund, you used to actually buy a 10-year treasury bond from me, but now 10-year treasury note. Now you're actually just buying a 10-year future, and it's just sort of like all made up like on the computer. I mean, it's all made up, obviously, but I was just actually, if I can quote from the Fed's stability report from June 17th of this year, they say liquidity conditions in the market for Treasury securities, which had already deteriorated somewhat since late 2021, in part as a result of heightened interest rate risk, it has worsened in late February following Russia's invasion of Ukraine, and that market depth for Treasury securities fell and remains at historically low levels. So yeah, Treasury liquidity isn't great. I think when they say historically low levels, they're not including March 2020, which I think that's probably the worst on record. But yeah, I don't like nothing that I think the Fed is necessarily worried about. I think also they want Treasury yields to go up, right? So it's like the worse the Treasury market functions, and the better that is. The more risk premium people put on Treasuries, the more yields go up, and the Fed wants yields to go up. Yeah, so mortgage rates are ballooning, treasuries are going up. I mean, you're seeing some credit spreads widening out, which is interesting. I had been saying for a long time that high yield spreads, people would say like, oh my God, the high yield to worst is at 8%. And I'm like, yeah, because the risk-free rate went from like 0 to 3.5%. So again, you get those two bands of risk-free and then spread on top. But so up until 2 months ago, you weren't seeing the spread widen, or you would see it widen only marginally. You were seeing the risk-free rate, explode higher because of the Fed and everything, inflation. Now you're definitely seeing it widening. So that is something to note. So that's mortgages, that's credit. I guess we can move into the world. First of all, do you have any questions?
No, I think that was good.
Okay, great. All right. Let's move on to the Eurodollar curve. Oh, everyone loves the Eurodollar curve. All right, this is a chart I got off of Twitter, which shows the forward interest rates for Eurodollar, so 3-month LIBOR, London interbank overnight rate. And look at the yellow line and the red line. Ignore everything else. So the yellow line is of the 12th of June, and you were seeing this is all priced off the Fed. Again, some people say like the Fed does whatever the Eurodollar curve wants. I'm kind of in the other camp, especially now. But it was pricing in tons of Fed hiking up until like late 2023, when the Fed would get higher than 4%. As of June 28th, which is only a few days ago, we're recording this on Friday, July 1st. That has moderated significantly, whereas the Fed is going to hike even faster over the next few months to, let's say, December 2022. But it won't. The peak rate will be somewhere in very early 2023, and then so it's basically pricing in a Federal Reserve pivot, which is very interesting. So that, and I would actually fade this. I would say that. Even if we get a recession, even if we are already in a recession, I don't think the Fed pivots. And, I'm more in the yellow category than the red category. Let me put it that way.
I think a lot of this comes down to what the Fed decides is the appropriate rate of inflation, which I see as being higher, right? There's actually no reason historically, like 2% is kind of a number that's plucked out of thin air, right? And actually for a long period of time, the Fed was, almost wishing that inflation was a little bit higher than that, right? Actually, the problem in Japan forever is that they have not been able to get inflation, and any amount of sustainable inflation. It's really hard for me to imagine going back to a world where inflation is at or below that 2% range. And the reason why is I think there are some pretty big macro factors. It's all that stuff that you hear about the supply chain is completely and absolutely right? We've essentially had borrowed extremely low cost, we've borrowed from extremely low cost labor pools in the developed world and developed economies. And you can see geopolitical relationships breaking down in real time. I just don't think that we'll be as comfortable maintaining as much of our supply chain in China, in Vietnam, in those sorts of countries as we have in the past. I doubt that we end up moving our manufacturing back to the United States entirely. I think that's too much of a shock. Could be Mexico or, other low-cost countries that are more local, but there's enormous frictions that are associated with that. There are price hikes that are associated with that. And also, I think we've kind of broken, unfortunately, that mental psychological barrier that's hard to put into an equation around inflation. People have come to expect prices going up. I think it's going to be much harder for the Fed to rein things in than people thought. But at the same time, I don't think that the Fed can continue to hike rates at the rate that they're going without causing serious problems, right? We're kind of feeling this in crypto first. Crypto might be, for all the people doing grave dances on crypto, we are most likely the canary in the coal mine here, right? For what is going to happen to the rest of the economy if the Fed continues on its warpath, so to speak, right? Of hiking rates while at the same time, drawing liquidity out of the economy with QT. So I don't know if I would fade this or not. I ultimately think we probably just settle towards something that's higher sustained inflation. And the Fed says, exactly, that's what we really want. 4% inflation is actually what we want today. And then the market will just accept that, but over time. But I kind of think that's my rambling vision of the future.
So you're team red and I'm team yellow. Let us know in the comments what team you're on, people.
Yeah. Red. Wings. This episode is brought to you by Blockdaemon, the world's leading blockchain infrastructure platform. Blockdaemon's mission is simple. Make spinning up a node so easy a 5-year-old could do it, and so secure that any chief compliance officer in the world could sleep easy at night. In plain English, Blockdaemon allows anyone, whether you're a crypto-native fund, a financial institution, a DeFi protocol, whatever, to participate in crypto more safely. For some, that can mean participating in governance. It could mean gathering real-time and accurate data. It could mean generating yield through staking. Whatever it is, when it comes to crypto, infrastructure is edge, and there's simply no better edge offered than the one from Blockdaemon. Blockdaemon supports a range of services on over 50 protocols, and that's a growing list. They have multiple layers of risk mitigation that include regional and data center diversity, 24/7 human and automated monitoring, a full-service team of engineers to avoid technical difficulties, and things like slashing insurance. In other words, they literally make it foolproof. If your organization relies on real-time, accurate data that comes from blockchains, please click the link at the bottom of this episode and go check them out. Again, it's important. Gotta click the link at the bottom, otherwise I won't get my credit. Jack, what else do we have here on the macro side? Because I want to make sure that we have some time to cover. It's been a very busy week in crypto as well, right? So I want to cover some of the stuff that's going on with FTX, credit contagion, etc. So let's, what do you want to close out on the macro portion here?
Yeah, I guess put up a chart by our great Will Beaumont. Let's see if I can find it.
Those of you who don't know, Will literally gets the best charts in the game. Shout out, Will.
He does. Yes, he does. Okay, so it's very small. So on the top is the so-called TED spread, the spread between the 3-month overnight index swap and 3-month Treasury bills, and you're seeing some stress there. We don't really have time to get into it. And on the bottom, something that's I think easier to understand is just credit default swaps on brokers. So I think like the black line is like Morgan Stanley, which owns E-Trade. So so I think part of this is just like the market has stress. So people who sell credit default swaps, like the big institutional banks, like the spreads just widen out. But I think a lot of that people are like, is my money safe? Is my money safe? And that, Mike, because we only have 10 minutes left, is a great intro into crypto because, you've had a lot of like lenders where they're not necessarily they're not FDIC insured. There's kind of been a run on the bank. So tell us what's been going on crypto because I've been so out of the loop.
Yeah. So I can give you kind of like the high level summary here. I'm going to actually steal a quote from Jim Bianco, speaking with in 10 minutes. But basically, Warren Buffett's got that quote, when the tide goes out, you see who's swimming naked. And we realize that we're living in a nudist colony. I think basically, what ended up happening was people underestimated the effect that crypto is correlated to the interest rate cycle. I think as interest rates started to rise, crypto started to respond. And I think as the proverbial tide went out, we started to understand two things. A, just how much leverage was actually in the system when it came to crypto. And B, just how little we understood about how that leverage was connected, right? So there were a couple of pretty high profile blowups that are basically, we're seeing everything unwind. And they were Terra Luna, right, which really kicked everything off, Celsius, and Three Arrows Capital. And honestly, of those three, it seems like Three Arrows Capital was probably the largest and the most impactful, especially for the CFI lenders, because just like the case of long-term capital management, right, when all of the banks essentially realized that they all had the same largest customer in 1998, which was LTCM, all of the CFI lenders essentially realized that their biggest customer was the same fund, and it was Three Arrows Capital. And they were, at best, extremely irresponsible in terms of how they were managing risk. And at worst, there was some criminal activity that was going on. So basically what you're seeing right now is leverage unwind. And many lenders took hits, right? So, all of this is public information, but, BlockFi is kind of teetering right on the brink. We saw a pretty unbelievable article come out that was reported by CNBC that FTX was going to acquire BlockFi for $25 million. That has been publicly refuted by the co-founder of BlockFi, Zach Prince. But we haven't gotten any more information. And, this comes off the back of FTX extending a $250 million revolving line of credit with, and I'm not sure if this is what I've heard. I'm not sure if this is publicly confirmed, but the rumor mill is right that there was some sort of convert there, right? If repayment can be made, then some amount of ownership would revert. So, I think basically Sam Bankman-Fried is kind of stepping in and deciding when and where to bail out these CFI lenders, because what we're seeing is just a good old-fashioned credit contraction. People don't know who they can trust. They don't know who has exposure to Three Arrows Capital or other entities that might be impacted by Three Arrows, and it's just not public yet. So nobody wants to lend to anyone. And I think what Sam is trying to do, I think the White Knight, the most charitable version of that, and honestly, I think I kind of believe this, actually. I think he's literally trying to step in and shore up confidence in the space, because it's a losing proposition if everything just fails. I guess, the other side of that, the other interpretation is that we don't really want someone owning, walking away and owning half of, the centralized infrastructure in crypto. That's just kind of antithetical to the whole ethos of the space. So that's, by and large, what's been happening in the space.
Yeah, I think the way that those positions in long-term capital management were unwound was the Federal Reserve got everyone in a room and was like, all right, you'll do this $1 billion swap with them. You'll assume their liabilities. You could pitch in, $500 million, blah, 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 blah. And suddenly, a financial crisis was averted, at least temporarily. And I think, the one thing about crypto is there's no central bank. So SBF is kind of, yeah.
Although the central bank didn't actually extend any of their own credit. They orchestrated and basically bullied and ordered the large banks at the time to all contribute money. And they kind of quarterbacked a bailout, but they didn't actually put up any of their own capital at the time.
Yes. Good point. So my question is, what sort of loans were made? So let's say BlockFi, lent to Three Arrows Capital. What kind of loan would that be? Sort of I know what a TradFi loan looks like, but what does a crypto loan look like?
It's hard for me to really speak directly on that, because I don't have any special information about what that was. What I'm assuming here, and this is the realm of speculation, if I was sitting in Sam Bankman-Fried's shoes, I would not just be extending credit here, right? Because the risk reward is simply not there. You don't see anyone else jumping in and offering these bailouts. Actually, CZ on a live stream with Bankless today said that he saw all of the deals that Sam Bankman-Fried saw and he passed on them. Right. So that kind of tells you a little something. Right. If I'm him, I'm not extending these sorts of loans without some sort of equity convert clause. Right. And this is what Ken Griffin over at Citadel is pretty famous for. Right. When hedge funds are troubled and they need a lender, Ken Griffin is all too happy to extend. But at the price of, if I don't get paid, then he assumes an enormous amount of ownership in the company, if not outright ownership. So I would guess that's what's going on.
Right. Yeah. I mean, isn't that just a company going bankrupt? If you owned Hertz stock of Hertz, and I was a lender, if they couldn't pay me back, what you own is worth zero, almost by definition, right? It's just kind of like an accelerated scenario, where it's not a bankruptcy where it's the equity holders, they don't get zero, but they get very, very little.
So there are kind of two types of risk that are going on right now in terms of crypto, right? There's asset liability mismatch and there's duration risk, right? without getting into the specifics of asset liability mismatch, duration risk, ironically enough, is what took down long-term capital management. That's when you're basically betting on a convergence trade and you take out leverage for two securities once they've broken out of their correlated range to return. Now, the funny thing is, for long-term capital, they most likely, if they had been able to hold on to their positions, if they hadn't been as leveraged as they were, those would have been winning trades. The undercurrent thing here, what's going on, GBTC ended up being a systemic risk for crypto, right? That is the Grayscale Bitcoin Trust, roughly $40 billion in assets at the time. And there was an arbitrage that was like the worst kept secret in crypto that everyone knew, which is that basically what you could do, GBTC is a box. You put Bitcoin in the box, you get one share of the box, right?
Careful with the box. Careful with the box, Mike.
All right, whatever. It's a box that trades publicly and it's basically Bitcoin. So what you end up doing, and there was so much demand right at one point to buy that, to be able to get exposure to Bitcoin in a public way through your brokerage, that it traded at an enormous premium, right? And what you could do is accredited investors could buy shares of the box at market value, wait 1 year, and then redeem at whatever the market value was. Sorry, you could buy at par or whatever, and then redeem at the market value. So basically print 40% premium. What people didn't count on was that it would shift into instead of a premium to a discount. So again, theory is if you can hold on to that trade for long enough, you will probably made whole if you trust that Grayscale is a well-run operation, which honestly I do. But the problem is a lot of these lenders, Three Arrows, right? Three Arrows very publicly at size, they owned like 6% of the Grayscale Bitcoin Trust. So, if between now and then, you don't have enough liquidity to manage that, that's where you get in trouble. And Three Arrows, what they actually did too was they took a bunch of those illiquid GBTC shares and they pledged them as collateral to a bunch of these lenders, right?
And then when the price went down relative to Bitcoin, they had to pledge more collateral. Yeah, I own GBTC, so I know.
Yeah, and you'll probably, it's honestly, because right now I'm pretty sure it's trading at a discount of like 40%. So the implied price of Bitcoin that you can buy it is like 14 grand. That's pretty good. There's an additional layer of risk in there, right? That either, they're not successful at converting that to an ETF, or that Grayscale kind of screws you. But 40% is probably worth taking that risk.
Your IRA, although I guess you can now own like BITO in your IRA too. So I bought GBTC when there was no Bitcoin ETF.
Yeah,
I'm an OG. I'm a crypto OG.
You're an OG, baby. Look at you, Jack.
All right, Mike. We got 2 minutes left before you got to talk to Jim Bianco. So play us out. What are you looking forward to in the space?
Ultimately, I think I will be honest. I mean, I think like many people, and I think it's important, right? People are happy to call out where they're right. I will call out where I was wrong. If you go back and listen to roundups like this on the margin, 6-9 months ago, I was kind of saying I don't think, because we didn't have that blow off top, the spectacular blow off top in crypto, maybe we didn't deserve the pain candle at the bottom. I was wrong about that. Clearly, we're getting the pain candle. It's much worse than I would have expected. That being said, and I'm not going to offer financial advice ever, because crypto could continue to fall another 50, 60%, who knows? I don't know. On the list of bottom signals, I mean, this is just about as good as you ever get, right? I mean, it's like grave dancing, bears celebrating in the streets, calling people criminals, forced liquidations, media calling it dead.
Winklevoss, Celsius is on the front page of Wall Street Journal, the physical copy. Winklevoss twins have taken out all mention of the Gemini in their Twitter bios, and they talk about the band that they're in. I mean, that's pretty close. Yeah, I think if the 2018 bear market, which very well because you founded Blockworks, you and Jason in the bear market, like it only lasted a year, so we would be like halfway through the bear market, which sounds kind of bullish. But then also this bull market lasted longer than the prior bull market, so yeah, I don't know.
And I don't think that we're in the bottom yet, just because relatives still ask me about it. They're still like, hey, I'm pretty interested in that crypto stuff. That does not happen at the bottom of the bear, and people are still too angry. Like, but at the bottom of 2019, it was like desolation. It was like the proverbial tumbleweed was blowing through crypto Twitter. It's like no one cared about anything, So I that's what makes me think we're not totally there yet. But again, you asked me to round it out with something, but so this is not financial advice. I have no idea. And historically, you should probably do the opposite of whatever I do when it comes to investing. But sentiment wise, I think we've got a ways to go, but we're closer to the bottom, I think, than the top, if you put a gun to my head.
All right. Well, we'll leave it there. Thanks, Mike. Thanks for letting me be part of it.
Cheers, buddy. Talk to you soon.